Where do you buy in 2026? That is a question on everybody's lips and has been for time eternal. But on this session, we talk about some of those potential gems that you can be looking into. We spoke about spots where you might be able to see anywhere between 40 to 60% plus growth over the next 3 to 5 years. So these are some of the hotspots and emerging hotspots. So you have to tune in to this session. We also talk about, though, the process you need to be going through, because for me, that's knowing the hotspot is fantastic, and that is the result. On this session, we talk about how you research, how you understand markets, how to understand where you might want to be considering selling a property. We have the insights from the bird's eye view from Jeremy Iannuzzelli, who's a special guest co-host, and we had the absolute data magician, Matija, Djolic from HTAG. He is the CEO of that. And we even spoke about some of the considerations about the economy, interest rates. This is a far-ranging session on how to pick that next property market and where to buy in 2026. We saw significant growth some of the times that Matty has been on and talked to us about Townsville. He's talked about a little bit about Perth, and now he's speaking about one of the gems that is coming up on a lot of people's radars. And is there value in that property and in that property market? And it's south of the border, not Melbourne, this one. So great session, everybody. And hey, everybody, I'm Jeff Miles, and together with Joe Tugger, we've created Australia's largest property investment Facebook community. We've now over 85,000 property investors. And each week we interview the top property investment experts, and you get to sit along for that journey. This week is no exception. We've got Matija Djolic from HTAG. He's the CEO there. And we've also got the founding founder of Pradium Partners as the special guest co-host, Jeremy Iannuzzelli. Now let's dive in. We are live on Oz Property Investor. We're bringing big names and we have the big fun. And it is so much discussion. We're almost late. We almost missed the login. But no, it's a big session because we're going to talk about, well, where should you be considering buying in 2026? But more importantly, how do you actually do that research yourself? Because everybody just wants the suburbs. Very few actually want not very few that. But I think that's the most important thing. And what are the risks of these areas as well? Because Jeremy's got views on that. Matty's got risks and things that are driving that. So Matija, how you going, mate? What's happening?
Good, mate. Thank you guys for having me. Nice to see you. I haven't seen you boys in a while. I mean, Jeremy, nice to meet you. I've met you before, like we spoke, but I guess this is the first live.
Exciting, yeah. No, looking forward to it. And, a wealth of knowledge, Matija. What you release out on your platform, and a lot of commentary that you provide, and you do a lot of rounds for a lot of people in the podcast as well. So, mate, pleasure, and I'm looking forward to asking you questions for things I want to know. And everyone listening, we're all keen to know where we need to buy in 2026, because this is a year where we need to make money, especially as rates are where they are and potentially might jump up a little bit higher.
Yeah, I heard that today, by the way.
Inflation. What did it come in at?
Inflation is sticky, yeah.
What was the trim anyway? It was 3.4 before. What are we at? Well, I didn't see it, Jeremy. What did it hit today?
They're saying it's steady. They always build a bandwidth 3.4 to 3.6 as a band. So what it means is it's more entrenched than just a slight up and slight down post a Christmas break. There's a bit more they need to do to get real inflation down. Interest rates need to be at a Reserve Bank level anywhere between 1.5 to 2 percentage points higher. So for anyone out there that's listening, if you've got a 3.5% inflation, Reserve Bank really needs to have rates sitting at around about, say, 4.5%, 5%, if not 5.5%, to really bring it back down. So who knows what that means? Is it transitory, where we see rates up and come back down, or inflation up and inflation back down? Or is it something that Michelle Bullock really needs to rein in? And that could be, we might be the first Western country to raise rates post everybody decreasing them.
Well, we've already done it. We raised up in February, Jeremy. So we could be, so the US I heard the US is potentially talking about being able to cut them again, which is just interesting. But this is a conversation we'll probably have in a couple of weeks' time. So say sub, because tonight I wanted to ask how you're going, Jeremy, but you're telling me you caught a mile on the weekend, and how the Rabbitohs going to go this year? What's happening there? Anything? Is Wayne Bennett going to keep his job?
We've had a good trial season, so if the team keeps fit, we're going to be in for a good chance.
I keep teasing a mutual friend of ours that the Tigers were the pre-season premiers, and I said, well, yeah, let's see it anyway. We'll stop the footy talk, but no, Vegas on Sunday, the Doggies. Hopefully, yeah. Anyway, so for those of you who haven't seen Matija and you are very, I suppose, out there these days. Like, it's good to see you in amongst things. So you are the head of research and now CEO. Maybe not the head of research anymore. You're now CEO of HTAG and co-founder.
Unwillingly, by the way.
Unwillingly CEO.
Yeah. So we had to, because we had to restructure, and we got like this, 8 of us now. And there was like a vote, and I said, no, I can't be, because I can't really, I'm too direct, and most people don't like me, actually. So I better not be a CEO. It can be devastating to the business. But anyway, it was voted against my will.
Yeah. Wow. Okay. Interesting. You everybody wanted you, but they didn't. Yeah. That's.
I talk to people. I get to know customers. Like I develop personal relationship with our subscribers. A lot of them, they come to my house. Even I go to theirs. We spend a lot of time together, and I think it's but it's relationship with the community, especially in Mastermind, which has driven that decision, I would say.
Yeah, fair enough. And look, Jeremy, you are, I suppose, I saw the other day something about a 17. I thought you had a 20+ million portfolio. So maybe there's a story there you'll share, a longer story. But maybe that was old content. Maybe it's grown exponentially since you filmed that. But you are, you've got a 20+ apparently property portfolio. When I say apparently, maybe it's now under 20 because you sold some. But you've also got the podcast. What school should have taught you, which is an amazing sort of resource, and I've loved to see that grow. And it's not surprising as well, because you add value to anybody you come across. So thank you for jumping on, and in Joe's absence, I saw he's having fun in the snow in the Scandinavian countries. Good on him. But tonight, Matija, I wanted to know the first thing, because we'll get to some of those locations, and if you want a location or region unpacked, we'll probably have time for one at the end. So make sure you stay tuned for that. Drop it in the comments, because we're talking about Sunshine Coast maybe. But the first question I want to know is, what are the key things? We're going to go straight to the crux you need to consider when looking for your next deal from a data or otherwise perspective. I'll ask Matija first, but Jeremy, I'll throw it to you as well, what you think of. But first, Matija, what do you reckon? What are those things we should be looking at?
I mean, I've spoken about this. I'm a big advocate of, brief-specific research. Like, I don't even know why people go 12 rounds arguing about areas online, because they all suit different individuals. And now, I guess a brief would be a deconstructed future goal towards like the next purchase as much as you can. And usually we try to cover 4 or 5 questions, which have a plethora of sub-questions underneath, but, it's mainly driven by budget. A budget in itself also drives a lot of research, because, different metrics apply to different budget ranges, especially when it comes to steam factors, i.e. how long the area has steam, or whether it's going to double in a decade, etc. The second thing that I always ask is, how long do they want to hold the property in the portfolio? Because you're going to enter completely different markets if you're going to buy and sell in 3 years. You're going to enter completely different markets if you're going to buy and sell in 5 because you're buying under an SMSF, or if you're going to hold it 10 years plus. It's completely different. The third question we usually ask, and this sort of increases the complexity of the analysis, because most investors want to build their portfolio, so they would need to understand, okay, when am I ready to buy again? When will I have serviceability, i.e. when can I be in a position to release equity to buy again from the next purchase? And, whether I want to release equity in 2 years or 3 years or 4 years. Now, that introduces an additional domain of time, because not only will you be analyzing areas from the long-term perspective, potentially if you want to hold it long-term, but you also need to understand, the short-term and mid-term momentums to release that equity. So again, if you want to release equity in 2 years, you need to buy in a hotspot essentially because a hotspot has that momentum that will generate at least 20% growth in the next 2 years to make it meaningful for you to buy again. And then finally, but this one is really connected with the time factor. So the second question that I asked, how long do you plan to hold the asset in your portfolio? If you're going to hold it long-term, 10 years plus, you need to have low risk. And fourth question is, what is your risk profile? Why do you need to have a low risk profile? Well, first, different people define risk in different ways. I guess I define it as an impediment to an outcome in a sense. So if you are, aiming for capital growth or cash flow, there are certain things that are going to potentially stop you from getting there. And it usually relates back to industry levels of industry diversification, exposure to dominance of mining and agriculture, negative environmental effects such as bushfires and flooding. And, when you combine different answers to those questions, you probably get about 20 different permutations of strategies that you can invest under. And that really sets the tone for the next stage of research. I think diving into an area right away, and just to give you an example, if you have the serviceability and you can, build your portfolio fast, a 2% growth difference at the onset can be, $1 million on a 30-year mortgage term. You know what I mean? So, if you can have the capacity to relinquish equity in the next 2 years, you're going to be looking at completely different areas than if you want to sort of enter an area sooner and sit on the sidelines for about 4 years to generate that 20%. So those are the usual questions that are asked. They usually come with additional caveats, like, for example, I'm looking into this area, I would like to invest here. I usually discourage that because I let the information drive the delineation of the area, as opposed to us inflicting our own bias into where we want to buy. And additional questions such as, for example, there's land tax, I hold X amount of properties in such states, or, I want to turn it into a PPOR down the track, certain things which can affect, where you look, but predominantly it's those 4 or 5 questions that I ask.
Yeah. Wow. That's a lot there unpacking, Jeremy. Otherwise, I'll throw this out there, and we don't have to talk about it the whole time after this. But this information is general in nature, not taking into account your personal needs, objectives. Speak to your brokers, accountants, financial planners. Jeremy is one, and there we go.
Photo. I love that photo.
I know it's original. It's one of the OGs. Jeremy, how do you think about what Matija just unpacked there? Do you take it all back to budget? Or?
Look, as we all know, there's a whole bunch of things that goes into it. Now, I can probably openly say I've never gone into that layer of detail or data for my own portfolio. I've always had a bit of a feel of where things are getting spent, what my clients are doing, what other people are doing, where migration, where population's driving to, and that will kind of dictate my decisions. I used to really follow, job creations and level of infrastructure, until I started to read some things that it takes about, 800 people to build a solar farm and then about 30 people to run it thereafter. So, anyone that's listening and thinking about, the Olympics in Queensland, all this infrastructure going to get built, there's going to be so much growth. And I just remember the 2000 Olympics, although I wasn't old enough to really understand the economics of it, but talking to a lot of people in the know and people with the experience, they said, when building all the infrastructure for the 2000 Olympics, you couldn't get a concreter, you couldn't get a jib rocker, you couldn't get a painter. And then it all got built, it sucked up tens of thousands of jobs. Olympics 6 finished. All of a sudden, there was a stack load of people unemployed because there wasn't all this infrastructure there to continue the demand of employment post a lot of that infrastructure getting built. So you've also got to look at, if you're talking about very generic data, infrastructure, the government's going to spend $10 billion. Well, that's $10 billion over what time frame? And it's going to create 10,000 jobs over what time frame? And to me, that's what drives an economy. That's what drives an area, the sustaining of population, the sustaining of jobs. The big thing you mentioned was, people's decisions around should they be buying a property for a couple of years? Should they be buying a property for 10 years? I always say you should always try to invest with a long-term mindset because no one can get it 100% correct. But in saying that, often you'll see things move very quickly, like happened in Perth. But often statistics and averages are there for a reason. That's where things do and will always revert back to an average. It has to. So that's also a lot of people need to remember. You might have bought really well and bought with 150% growth, but it's just making sure that that's sustainable long term.
Yeah, and I think that's a mistake. It's not a mistake, but it's, I suppose, people not understanding back to, and Peter, we're going to have some locations for 750. I don't know the location Matty has brought to us tonight, so I'm excited to see what he's going to talk about. But I think back to my point about if the biggest risk that some investors can face is that they don't actually know what they don't know. They're just going to Darwin, they're going to Hobart, they're going to Geelong, and then they realize they're like, they're going to Townsville, Perth, and I want to ask a question about that. But yeah, it's just interesting that they then sort of are going with a long-term mindset, and then they're sort of buying into a market that, yes, is going to perform probably quite well in the short term, but the other fundamentals there, maybe not. So, Matty, I want to throw this one.
What Jeremy mentioned, just to I think that's a very crucial factor that he outlined. It's the I mean, growth is a factor of time, essentially. And when you spoke about infrastructure spending and timeframes, and I went 15 rounds with about 200 people in my tenure when it comes to defining infrastructure spending in different ways, just because there is spending, what Jeremy has mentioned, in a particular area, we have to consider, okay, when will this spending permeate into pockets? When will people be using that money to actually spend, and what will happen thereafter? I think that's a very, very crucial factor, because just assuming on face value, you have a lot of infrastructure spending in mining towns that are not catering to the population, but just building roads and bridges for the actual exports or the mine. And then once that subsides, what happens then after? You know what I mean? So this is why it's important to understand, we mentioned in a call before, it's like this triangulation, looking at many sort of different pieces, trying to fit the puzzle and understand what's underneath each metric that you're actually looking at. So I completely agree with Jeremy.
There you go. It's very cordial tonight, guys. So far, Brisbane is the front runner. If you want a location or region unpacked, so let us know. Drop that in the comments and stay tuned. Before we go into some of the areas and how's Darwin City Unit 1 bedroom? I'll expand out that question for Abhishek, but answer it if you want to, I suppose, Matija. But I want to say, what are your thoughts on some of the hotspots, though? Because this is probably a current hotspot, we'd say. But how do you think about Perth and Adelaide and Townsville? And answer, I suppose, Abhishek, if you're 1 bedroom unit in Darwin City. I don't love the sounds of it, but maybe that's my bias.
You're asking me?
Yeah, you go. Of course, mate.
Yeah. So now, as I said, like we started off, trying to define the individual brief. And again, these areas that you mentioned might be suited for some individuals. Like, we all know that Perth and South Australia in general, they've gone through substantial amount of growth in the last 4 years. There were 2 states that were essentially leading the growth pack. And, there's still some steam left, but we can see tapering off, especially on the demand side as well. So if individuals want to capture that momentum and generate around 10 or 15% in the next year, those areas might be suitable. The only thing that I have to ask themselves next is if they have a long-term investment time horizon, when it does revert back to the mean or the average that Jeremy was talking about, how long will it stay there? And then does it have the opportunity to go through another cycle of growth so you can potentially, release equity twice or third time from the same asset? So I don't actually, hold, there's this, I guess, culture online about, supporting and sticking to areas. And we had a bit of banter regarding Darwin in this group as well. I'm not in particular in favor of anything. I'm in particular of finding the right location for that individual, So I mentioned about, for example, Perth and South Australia. Now, let's say if we go to Darwin or Townsville as well. I mean, Townsville was a great play in 2023. If you invested in 2023, you would have made 50 or 60% returns. Now, the next question is, okay, how much room does it have to go? Does that align with my equity release time frame? And then how long is it going to stagnate for? Because everything grows to cycles. Nothing is perpetual in life. Nothing. So that's one thing that I really want to hone in on. When it comes to Darwin, Darwin was appearing in our shortlist, as you know, Jeff. I was commenting regarding Darwin, and me and Ricky had a bit of banter in the group as well. Darwin was a great play year and a half ago, and I mean, I have plenty of recordings. Even now it is, but I had plenty of recordings where I had strategy sessions, or even in our mastermind community. I always put a caveat there, and I said, to me, Darwin is not a long-term play. I would really reassess my position at the 5-year mark. See how the supply is tracking. If supply is still reducing, that means you're going to stay above the 0 line of growth, meaning it's going to compound in a positive way. But it is risky because its growth curve, same as with Perth, for example, is questionable when you look at history. Now, history doesn't repeat itself, but it rhymes. And if the aspect of, probability is taken into question, if I have 2 areas, that one that is, not volatile and has been compounding at a, average rate of 6 or 7%, and one that's extremely volatile, but then experiences these enormous births within 2 or 3 or 4 years, you have to pick your poison, you know what I mean? And then again, that depends on the risk profile, where you are in the cycle, etc. So coming back to Darwin, I do think that there's definitely room to grow in Darwin. And when I say Darwin, people think like Darwin as a general, like it's just, LGA city level. Darwin is a very particular beast in a sense that I like maybe one area in Darwin, maybe two. but one, so, and even that one is to me a midterm play. Now, if you're investing, for example, under an SMSF, you want to take advantage of the capital gains discount, you want to recycle those funds into additional purchase and proliferate more, as opposed to just wait for those contributions to come in. Absolutely, it's a great play, So again, horses for courses, I would say.
How do you think about that, Jeremy? Because
I agree. Yeah, I agree. No, look, I've been saying it, and I spoke about Northern Territory over 12 months ago now. Seen it probably even 16, 17 months ago. A lot of buyers agents were starting to buy there. And for me, the prices were cheap. And I always said it would be very transactional because population there sits at probably 500,000-600,000 people. So not a huge amount of population there. Yes, there's spending. There's a lot of government spending there. But there's not a huge amount more other than that. So what's the driver for it long term? But if you can ride those waves, get in and get out and have a 2 or 3 year horizon, I've done that. I just released a video myself for buying a property in 2023, selling it in 2025 and making $250,000. I could have held it for another 10 years, but I was happy, to make 250 grand. That's cash on cash return of more, 150% of what I invested. I'm happy with that. So I think that's important. What I'm starting to see now is growth being spurred on because of real growth, which is population movements, again, money coming to the area, other things, desirability, or is growth being spurred on because of price point? And I was at a think tank with a lot of really good professionals, and there's an aggregator, quite a large aggregator in this country, and I won't mention the name of who they are, but they released some results of the calendar year 2024 and 25. And 71%, I think it was actually 72% of the loans that they wrote. Now, this is an aggregator handling billions and billions of dollars worth of lending a month, not a year, a month. And 72% of the loans that were written were for loans or purchase prices below $650,000. 72%. Now, let that sink in for everybody that's listening. If we got a median house price in Sydney of, say, 1.5, a median house price in the country of, say, 1.1 mil, and you've got almost 3/4 of the purchase prices in the investment space being around that $650,000 price bracket, then we've got to ask the question, what's spurring on, say, growth in certain sectors? And does that maybe change the way we think? Because if it does, if there's nothing wrong with following where some people are, you just got to make sure that it's, as Matija said, it's within inside your risk profile, it's within inside your strategy, and you're aware of what you're doing. If I go into an area and I want to be transactional, that's my business plan from the start. I don't expect to get unicorns when I'm buying an older property, say for argument's sake in the southwestern Sydney. I expect to get those level of results. So it's important that you are identifying that, but also knowing where the trends are. Because at the moment, it is sounding like there's a huge push for affordable investments. And I've spoken to lots of clients. Their price bracket's always sitting around about that $550,000 to $650,000 mark, and they're investing in areas at that price point. So that's all they can afford. If most people are in the same kettle of fish, well, then that's going to drive certain markets at that price point.
Yeah, it's interesting.
Yes. See, I think one very important point there is that when you're investing, there's an entry strategy, but you also have to think of the exit strategy. Like when will I exit? Why will I exit? For which reason? Et cetera. So again, I always caveat things and I say, well, this is a 5-year play, and I give an explanation as to why. Now it might be 6, it might be 4, it might be 7, but I'm saying around that halfway mark, you really need to reconsider because potentially things could go sour. So I think. I've seen a lot of, recently I've been doing a lot of assessment of portfolios, for example, in strategy sessions, and I see a lot of people buying in certain areas are not actually having even though they bought long-term, but they don't have a long-term view. And some of the areas where they bought in, I believe personally have no more steam. And the next question is, okay, but when do you think I should sell? It's too late to ask that question when you already bought and you invested 100, 200K. So you should enter with that kind of a mindset and sort of have, nothing works perfect, but if you have some kind of a plan or guidance, I think that's very important.
Yeah, and off the back of Matija, sorry, Jeff, to interrupt. I know you want to mention something, but off the back of Matija, when I'm picking a time to exit a property, I'm not actually necessarily looking at price as an exit point. because you could have a property that's gone up to $1 million, but if it's lost its steam and it's lost its amount of velocity of people coming there to see it, your price is worth $1 million, but no one's paying that now. And it's what you're prepared to take is now setting the new price point. So me, when I'm deciding to sell or exit, I'm not looking at price. I'm looking for 60 people turning up an open home. I'm looking for agents saying I'm getting 35 buyers, agents calling me hunting for property. That's what I'm looking for. And that helps create, obviously, competition. And with competition, they drive price rather than having a property sitting on the market for 6 months and expecting a price that may never come. So you also got to think of that as an exit strategy for people listening. It's not about price. It's about the velocity of interest that's there. And that will then dictate how quickly things move.
I mean, we could just have a whole podcast on because there's so many questions I have around that, and it's just curiosity because I know it's sort of people are thinking about it now. It's almost like property has become a commodity, which I'm not going to pass a judgment whether that's a good or a bad thing. I mean, maybe it's not a great thing, but it is probably the reality of what's happening on because people are unfortunately not able to, wages haven't kept up. They're not able to support themselves and their financial futures with that. So they've sort of decided, okay, I'm getting on that market and entering, exiting. But I'm going to park that to one side. As much as I know Joe is here, we'd have an 18-minute discussion on that. And I'm looking forward to when Joe comes back because then we can have those discussions. But Matija, we came here to talk about where we should invest in 2020, where we should buy in 2026. What are some of the picks that you're considering based on some of the research you've done? Like, and throw as many caveats and disclaimers out there as you need to, but let us know where you see some value potential.
Yeah, I mean, I think the best thing to highlight is, for example, on our platform, the way people get to a particular suburb is they have to follow a certain amount of steps in order to print out a PDF report, and they have to go through, a brief creation, shortlisting, ranking, comparison, and then they will print out a PDF. It's sort of fixed in that way, a little bit deterministic, in order for us to provide guardrails to ensure that the users who are using the information actually pick the right, suburb. Like it's interesting. I sometimes used to get questions. Let's say people include some filtering and they get a shortlist and they say, HTAG is supporting this area. Well, no, you got to this area by the filters and what you actually looked at and assigned, which produced a shortlist, which sort of, inclined us to build some guardrails to ensure that everyone follows, I guess, the process. And one of the things we publish on a monthly basis, which is really popular in our mastermind community as well, we publish bubbles. And bubbles are essentially, and I think you've seen them before, Jeff. Yeah, bubbles are the amount of downloadable reports that are executed within that month, and we publish that on a monthly basis and been doing so for the last couple of years. So I think a good thing to start would be just to highlight those bubbles to see what the professionals are and investors are downloading. Now, as a caveat, I like to note that in order for them to download that, they go through a process. They go through a process of defining the brief that I mentioned at the onset. They need to then shortlist and they need to do a comparison. And we've got a comparison module that allows it to compare all of those suburbs across 200 indicators to then settle on the top one and then print out a report, So I'll share the screen. I think it's an interesting, it's now just to say as well, again, this is downloaded reports from people that are downloading, and using the platform. Now, people might be using the platform for a variety of different reasons, I would say. They could be using the platform for, let me just see, this is loading. Can you guys see?
That's me. Yeah, we can see it. I'm just
just playing with the there we go. He's playing with the way that it's set up.
Yeah, so we can see now this doesn't guys relate. I don't know why. Can you see a full screen though? Oh, here it is.
Yeah, there you go. So, you got it.
Yeah. So now, as I said, guys, before, this doesn't mean that these areas that are being downloaded are actually suited for you, but it does speak about velocity that Jeremy was talking about. So, we have every state. You can see that Victoria is being dominated by downloadable reports. Big ones, Craigieburn, Williams Landing, Cairo, Golden Square. No, sorry, Cairo is Egypt.
It is a little bit like Cairo.
Yeah, Point Cook, I can't pronounce this one. How do you go? Pakenham.
Pakenham. Yeah. Mate, Pakenham, I remember So I've got a cousin that used to live out in Pakenham, and it used to be absolute farmland, and now it's probably built up and a little bit industrial in parts. But yeah, it's an interesting location, Pakenham. But yeah, go on.
Yeah, so we have Hoppers Crossing, Craigieburn, as I said. Now, if we go to Queensland, what's in Queensland, Curvin is still. And now, see, the Queensland was, I can tell you that, for example, Victoria suburbs are more on the upswing. They've bounced it off the zero line, essentially. They're sort of climbing up, which means they were at the bottom of the cycle potentially a year and a half ago. I mean, we do see some Victoria areas already returning above 10% average in the last year, which would theoretically make them a hotspot, but I don't think that it's a hotspot that's reminiscent of what a hotspot was in WA and what a hotspot was in Townsville, for example. Now, when we go to, the Queensland areas, which is, essentially orange, we see some of the areas, and these areas, I would say, are at the peak of the cycle, or approaching peak. So we see Springfield Lakes, Curvin is definitely at the peak. Mount Louisa's, as we can see, Gracemere, is that how you pronounce it? I'm very bad. South Townsville, some of the bigger ones you can see here. And the size of the bubble essentially relates back to the size of the interest. Now, what we've seen in the last couple of months is that, essentially this would be New South Wales. So New South Wales started being downloaded, as well as other states such as Tasmania and ACT. Being downloaded more. Charlestown in New South Wales, Orange.
A lot of regional areas, which is I suppose conducive with what people are looking for. Regional New South. They were talking about regional New South Wales as a resurgence. It had a little bit of a
which relates back to your price point as well. And I do agree. I think 9 out of 10 briefs that I get are below 600K. So definitely affirms what the aggregators' results are. Now, as I said, in the last, I think these bubbles, if I was saying the last 6 months, they were purely dominated by Victoria and by Queensland. But recently, as I said, we started seeing resurgence. We can see that, let's say WA is not getting much interest. I mean, the size of the bubbles is very small and is not getting much interest now. Tasmania, for example, we can see that it's on the outer layer, but there are some reports that are really, being downloaded. And there's a lot of interest in this area. And I think, guys, if you really correspond this to the behavior on the ground, you can definitely see that there's more interest within those areas as well. Let's see, this one here is Glenorchy.
They always, these suburbs, Matija, they've always popped their head up all the time. Glenorchy, Launceston, Hobart.
Bridgewater. Gazebrook might be in there probably as well.
If I go one by one, these are small, hence these are very small. And I mean, I can share these bubbles, guys, with the community as well. We publish it online. Now, ACT is interesting. I just want to see ACT. Now, this is Djolic. I see Djolic is the only one that's popping up in Northern Territory. I think there's a few. No, this is the ACT one. We have Caldwell. We have Gordon. We have Melba.
Southside,
McGregor. And essentially the ACT areas, I would say they're for a much higher price point, about $750 and above. In Queensland, you could get, still potentially something below 700K in Cairns and in Townsville. But as I said, again, the caveat is that it's the top of the cycle, while the areas such as ACT, Tasmania, New South Wales, and even Victoria, to an extent, are sort of rebounding off the zero line, I would say, and are sort of increasing up. I would say that if I had to do an equity extraction timeframe or equity release timeframe analysis, i.e., when will these states or these suburbs get to 20% minimum, I think for ACT it would take 3 to 4 years. For Tas, the same. Victoria will get there sooner, 2.5 potentially, considering how much growth it has seen in the last year. New South Wales is maybe 4 years, some areas, but this is essentially it. These are the downloads that have been happening in the last month, and they've been tracking like they change. I mean, the biggest bubbles in the middle are Victoria and Queensland, essentially on the outer layer, and the suburbs remain consistent for about 6 months, and then they shift. And they shift as the data shifts and the demand side improves, etc. So this will be on the high level, I would say. Now you can hone in on, I guess, more delineated areas and see what is brewing in a specific location if you want.
Yeah, how do you yeah, I was just going to say, so Victoria feels like it is the location where a lot of people are looking. I know this is a very general sort of comment, and it's not, I suppose, a trade or industry secret that Victoria has had about 8,000 podcasts on it in the last 2 days. Maybe not that much. I'm being dramatic, but you sort of say, well, how do you then sort of feel about, not feel, but let's take the emotion out of it. What do you sort of then see about the activity that's going on in Victoria? Is it actually, is there the data sort of supporting the capital growth, or is it people mostly saying, okay, it is going to grow, and now I'm continuing to buy there? What is that?
No, it is supporting. I mean, we see in some areas, Caroline Springs has had 9% in the last year. Mildura has had over 10. I mean, Karoon Downs has also increased, and I think it's sitting closer to 10 as well. So the growth is there. Now, when I delineate markets, I would say that anything above 10% would be already a hotspot, theoretically. Reason being, it's not an arbitrary figure, but it's actually linked to behavior on the ground. Usually in those areas, you'll see, 10, 15 offers for the same house. So the growth is there. Now, as we all know, the yield compression is significant in Victoria. Now, you can look at that in a variety of ways, So the way I look at the yield compression is that, growth has been outpacing, capital growth has been outpacing rental growth for long periods of time, So if I'm interested in a capital growth play, it's not a bad thing to consider as long as I can cover the shortfall. So now, in saying that, we do know that investors gravitate towards higher yields. Which means that in order for you to see exorbitant price growth in the short term as well as in the long term, you need both cohorts participating or competing for the same assets, both investors and owner occupiers. Now, noting that Victoria does have a yield compression because all of these areas that I've just mentioned probably have a 3.5% yield at the moment, or thereabouts, growth. So, but we do still see investors gravitating to these areas, surprisingly enough. And what has changed for me in the last, I would say, month, as I said before, 9 out of 10 briefs before were below 600K. Recently, I've been getting briefs that are around 750, and I don't know what the reason is. I just want to see whether the trend will continue, which is peculiar in the context of interest rate increases. So I don't know whether it's just a blip in the data, or whether people are still willing to stretch themselves out to enter a market just so they can secure an asset, which does, I guess, introduce some risk down the track.
Yeah, look, and I'll probably say what I've seen of that, Matija, about why people might be stretching themselves a bit more. The convergence of markets between the lower end, the middle end, and the higher end. The higher end potentially stayed still. Some of them have taken off like a horse, but stayed still. But that lower end and middle end now, they're very close to each other. Where a property was 300 grand, and we'll use Kerwin as an example. Gravesmere, we'll use, Townsville, these things were selling for $300,000 4 years ago. They're now selling for 600, 650, if not more. Now, to have that significant price increase in such a small time, that's now caught up with other areas where there is better value, for argument's sake. You are spending more, but you're getting a lot more for it. A better house, a flatter block, less issues with environmental impacts such as, crazy storms and cyclones and 90% humidity. So that's also probably another thing that's creeping in. We were talking about this last week, all three of us, as a bit of a pre-pack to today, but I get to see things really quickly. I get to see as people are signing contracts because I get to have that chance to have a chat with them about structure or whose name it goes in. And I always I said this about Perth, back in 2021, 22, 8 out of every 10 properties I saw were being bought in Perth. I saw that in Townsville in 2024. I'm now starting to see that in Tasmania. So it doesn't shock me to see that Tasmania is starting to pop up on there because I've mentioned to you guys in the last fortnight alone, I've had 30 clients buy multiple properties in Tasmania.
Just to go back, so people can actually see. I've just managed to filter in just Tasmania only, so we can see. Sorry, Jeremy, continue.
No, it's good because what your bubble graph shows, again, everyone listening, what it tells me is, hey, there's thousands of areas, 16,000 suburbs in the country. if you really want to hone in, the type of area you want to look at or the type of property you want to look at, sometimes investing with a herd might yield some results. Even you might get lucky. You might make a bad decision but still get lucky because another 10,000 people are right behind you. So that would give you the interest of what areas you may look at. But it's interesting to see Tasmania on there because it's one of the states that's been going backwards the last couple of years. And I'm now starting to see more and more people buy there because that price point, that $600,000, $500,000 price point starting to show value to a lot of people, and the rental yield attached to it. But interesting story about yield compression in Victoria. I first invested there over a decade ago. We're talking 13 years ago. One of the reasons why the rents were typically lower in Victoria compared to other states was the cost of actually owning the home. Agent fees were a little bit cheaper. Council rates and water rates were dirt cheap. And believe it or not, insurance costs were dirt cheap. So
it's still pretty cheap though.
Yeah. They are still pretty cheap in comparison,
come up a little bit,
but it's come up a bit compared to where it once was. So, I was getting, say, a 3.5%, 4% yield back in 2012 when I first invested in Victoria. Mind you, my net yields were better in Victoria than any other place I was investing in the country. And at that stage, I had properties in Queensland and New South Wales. And my net yield in Victoria back then was better on a 2 to 2.5, if not 3% lower gross yield. So again, anybody listening, you might have a lower gross yield in Victoria, but your net yield in the end after costs is what you really need to look at. Although not as good as what it used to be Victoria, and that's something you need to factor in when you're looking at your negative gearing potentially or out-of-pocket costs of maintaining and holding the property. Land tax being one of them.
Yeah. Going back, that's absolute, because that's, I suppose, thinking about your investing holistically. Matty, I wanted to ask, so Tassie, because maybe it's an elephant in the room. I don't think, maybe it's not. Maybe it's not one of those things. But you'd seen a couple of things I wanted to point out, and just, I suppose, I don't know whether the data considers this, and I think it does, this particular point, but the growth over the last 10-year period. Because you're seeing like Bridgewater, you're seeing Risdon Vale, like Devonport. I don't know so much about Devonport because I haven't tracked it as much. These areas have grown like 100, 120. And I know that just because it's grown doesn't mean it can't continue to grow. But would you say it as a second wind market, even though last 2 or 3 years it hasn't seen much, but is it a second wind market for a start? And what are the other, as a boots on the ground, like your URSAT is at 1 for some of these areas. So what is the risk?
Yeah, absolutely. So it's a good question. Now, there's 2 parts to that question. Well, the first part is, I guess I look at data and investing a little bit differently because I don't come from a property background. So the notion of second wind, the way I would define that is, I come back to steam that I initially mentioned. So areas can grow a lot in value, and Townsville was a perfect example, but if they still remain affordable and the supply scarcity, they will continue to grow. So that's, the primary driver of growth would be, if we look at, let's look at the difference between incomes, wage growth and property price growth since 1970, we can see that the gap is, phenomenal, which is why we come back to, the general price point of 600 and below. Now, when it comes to an area, whether it's a second wind, first wind, or continued steam, what you see is that if property still remains affordable for the general population, if there's severe supply scarcity and not enough property being bought, if only 2 owner occupiers go to market or go to auction, they're going to be competing each other and setting a new comparable. It's as simple as that. Now, coming back to URSAT, URSAT does play a phenomenal role, but for different price points. And URSAT, for listeners, is an index of socioeconomic advantage and disadvantage with developed by ABS, and within itself contains additional sub 20 or 30 even the indicators. It's a very robust metric. So now, if you're investing in markets that and we published an URSAT, we published recently to our semi-annual and elite subscribers, we published an URSAT white paper, which did correlation analysis across 4 different correlation methods to establish doubling effects and ceilings and friction points. And what is interesting is that URSAT areas that are below 600K and are of lower socioeconomic status actually experience more growth in the 5-year time frame than areas that are higher URSAT for those price points. Now, there is a psychological factor to that I think, and no punt or no dig, but that's how it is. The saying, poor people spend money now, rich people spend money later. And I think there is a considerable FOMO that plays a role in lower socioeconomic status standings, especially if the area is affordable. And that's why there are sort of bursts of growth. Now, the tricky bit becomes that you can't assume that that's going to perpetuate. So as soon as you hit 700 or 750K ceiling, your ERSAD can't be lower than 4. And in most instances, it should be 7 and above if you want to experience the doubling, So if you want to increase the probability of, let's say, all other things being equal, and we're looking at ERSADs, areas that have higher socioeconomic status and you bought at the 7 or 750K mark have a much higher probability to double than areas that are ERSAD 1, 2, and 3. Practically, areas that are ERSAD 1 and 2 have a 0 chance of doubling from 750K mark. So I guess, coming back to price point, low ERSAD, and again, time frame, and again, exit strategy. Yes, all of these areas have a lower ERSAD, but that's not going to potentially compromise their growth in the midterm, 1 to 5 years, if there's supply scarcity and affordability, and even improving short-term or long-term demand. However, at the 5-year mark, when the areas come to a 700K, you're already entering the friction zone, and you should reconsider. Now, you could potentially retain the asset if the supply scarcity perpetuates, which means that, it's not going to go into the negative growth zone. So you at least get compounding of 1 or 2%, doesn't really matter. But at that time, you should be reconsidering potentially deploying funds somewhere else. So again, it's like, what am I trying to do? What is the time frame? What are the frictions, et cetera, et cetera? So that all plays a role.
There you go. Well, we'll throw to our first sponsor, and then we've all gone missing, but that's okay. We'll get some of us back. Here we go. That's me. We don't want just me. So we're over here. So yeah, if I can work out which settings. There we go. We're all back. So there's been some suburbs, and there's been some general questions that people have said, and now I know it's going to be hard for you, Matija, but we'll sort of plug it out there with some of the metrics. Maybe it might be too hard. We'll see how we go. But we'll get back, and I want to answer some of the areas because it looks like Aararat. So just to prep you a little bit, I'd be interested to see in your views on that, Matija, and we'll throw to an interesting question from around a brief. And so stay tuned. We're going to be back for that.
Nice.
Everywhere you look, someone else is making money in property except for you. Your mate, he just bought a house. It's already gone up $100,000. There's some bloke on Facebook. He's bragging about pulling in a 7% rental yield. Meanwhile, you're stuck scrolling real estate and domain, confused as hell and having no idea about where to start. Or maybe you're that mate that's got $100,000 in equity. You have a few properties under your belt, but you feel stuck. You're unsure about how to scale without over-leveraging and not knowing what the next right move is. So why does it feel like everyone else has some kind of secret that you're missing out on? It's because they do. There's a reason some people keep stacking properties while others sit on the sidelines stacking excuses. There's a reason why some investors buy under market value while others pay too much. There's a reason why investors know the hotspots before there's any heat. And there's a reason that some people build $150,000 in passive income while others just spend years thinking about it. And it comes down to knowledge. And that's exactly why Jeff Miles and I, Joe Tucker, created the Level Up Property course to hand you the exact step-by-step process that we've used to buy over $100 million worth of property in today's market. We've built Australia's largest property investment community with over 80,000 members, and we help everyday investors secure hundreds of thousands of dollars in equity, all without wasting years of their life trying to figure it out the hard way. Making an uneducated decision on the biggest purchase in your life is just gambling with your future.
Stop it. Get some help.
And this isn't just another how to buy property course. Let's be clear though, this course isn't free. What? And neither should it be. This is our life's work. We've spent over 100 hours each on this course alone. Oh, babe. Okay, video number 3. Number 4 with million does... Fuck. Done. We've got decades of experience, millions of dollars in deals distilled into a repeatable process that you can take away for yourself. If you're looking for free advice, there's plenty of noise out there. You can go and find that if you'd like. But if you want real actionable, step-by-step guided process that works in today's market, then this investment is going to change everything for you. By the time that you finish this course, you will have full confidence. You'll have every tool that you need to build an amazing portfolio if you act on it, right? Which is why we have mentoring built in. So we kick you up the butt to make sure that you're kicking your goals. So the real question is, how much longer are you going to watch everyone else making money in property before you jump in and start playing the property game properly? Because the sooner you start, the sooner you start winning.
I love this video, man. I love this video. I honestly genuinely love this video, man. I was cracking up. It's so good and true. Sorry.
Thank you.
Yeah.
So what I was going to say, so if I recap what we've talked to so far, we're sort of saying that if your time frame is shorter, potentially shorter to medium, maybe Darwin could be an option. I'm not saying that unequivocally, of course, based on
not all of it.
Oh yeah, and Jeremy and I, we could all have a big conversation about that. But we sort of said Melbourne pockets of. You sort of summarised well that regional New South Wales and the ACT is starting to get, but that's like a more of a, would you say, cool transitioning into maybe a warm spot? I know that's a big, huge.
Yeah. I would say it's a warm spot because it's generated maybe 3 to 5% growth in the last year ACT, but it's an owner-occupied dominated purchasing market. Again, it suits a very long-term strategy and sort of de-risk like investing, I would say. But it's rebounded. It's generating. There's no supply. Like it's just crazy.
Damn land tax and ACT though, Jeremy. How do you feel about land tax and ACT?
Well, stamp duty is deductible for anybody buying a property that's residential in ACT, so that's a good thing. But yeah, it's a leaseholding fee that everyone pays. It's been built in there for as long as I can remember, decades. So it's just part and parcel again of the cost. You've got to have a look at the drivers. I've seen ACT bloat with people, and I've seen it have an exodus. So you've also got to really keep your ear on the ground for policy. Policy does dictate the way that ACT can grow, depending on the public service sector. And right now, we've probably had the most people ever employed in the public service sector, with the ACT taking up a huge chunk of that as well. Yeah.
So Aararat, that seems to have popped up a couple of times. I'm just picking out.
Is that next to Ballarat?
Ballarat. It comes before Ballarat, doesn't it? Because A and B.
It's on the left. I think it's west. No, is it really? Like, what's the LGA?
No. I actually don't know. I just thought that was maybe a funny joke, but not that funny.
I didn't get it.
I got it.
I didn't get anywhere close. I'm still
yeah, it is in the western sort of western region of. It's I don't know, halfway between. Yeah, so
I've got a question, Matija, that I want to ask about your program, because I think it's very key for a lot of people to understand. Is it measuring the people who are investing there? Are they investors or are they owner occupiers? Is it getting down on that? Is it as granular as that to understand who's actually buying the property?
Yeah. I mean, there's two sides to our platform. There's like I would call a static, but it's not static and dynamic. We built our own AI agents, so you can go very granular and find that information out. And demographics to a very small detail, absolutely. But you will start with the funnel, high level approach to actually hone in on the suburb, and then you go granular and see in your options. You will go and inspect that further, whether it's that or, for example, what I did is specifically when we invested in ACT, I did the comparison between aging population and incomes as well, just to see who's going to be paying off who's going to be paying my rental income. I guess 15 years down the track. So I did that sort of granular analysis because I knew what market I'm entering, what kind of employment there is. I knew that it's an owner-occupied dominated area, so I was really interested, for example, in the comparison between aging population, professional employment, etc. So yeah, you can do that.
Yeah, because it's one of the big things that I always like. Everyone's always asked me, Jeremy, have you always gone to see your properties before you buy it? My answer is yes. I've actually seen every single property I've ever purchased during the cooling off period. And I've actually pulled out of deals when going there during the cooling off period, because I walked down the street and everyone's front yard was a mess. There was, you could tell that was a street full of investors. You could tell that, a parallel street was full of owner occupiers because everyone's edges were nicely done. So I think that's important. Again, for anybody that's looking at all these areas that Matija put on the screen, I think it's brilliant because it gives you an understanding of, well, what is everyone else looking at? What's the new fidget spinner? And that's where you can make some short-term gains. But you also then need to look a little bit further. Pop your head over the fence to see what the next door neighbour's backyard looks like. Have a look, walk down the street. Who's got nice front yards and, who's got beer bottles sitting in the front porch? Because that will then determine again.
Yeah, absolutely. Like, for example, step number 4, if step number 1 would be brief, filtering, then step number 3 is ranking or detailed comparison. 4 for me would be, before I even use the AI, would be, you can look at different neighborhoods and pockets and even streets to see what the renter to owner ratio is within those pockets as well, to determine further and sort of layer on the heat map all of these aspects that you've talked about, just to make sure. Now, the thing is, though, in very tightly held market, you're sometimes bound by what the market provides you, i.e., obviously we have issues with listings, so you got to pick your poison in some instances. I don't think, it is very rare, at least in my experience, that I find and I tick every box possible when it comes to investing. I guess, trying to look for a unicorn also increases the time you spend on the sidelines as well, which you also need to address. So, yeah, I guess it comes down to how much risk you're willing to adopt. And as, Jeremy, as you pointed out, I definitely do look at renter to owner ratio on the neighborhood or street level just to see what I'm dealing with, and even
purchase, more so around the purchase level though, because if you looked at some areas around WA where it was, or that Bunbury and Australian region, I can probably say 9 out of every 10 purchases that were happening there were happening from Eastern Seaboard investors, not so much people that were already living in that area. So that dictated to me that that's an area that, hey, it's going to really push because there's just going to be more and more people that pile in. But as soon as those investors pull out and put their money somewhere else, you're going to start to see, well, there's no slack there to take up the gap. And that's
an issue with Darwin. Darwin, we see, don't quote me on it, you probably know better than me, but I think like 60% of loans are investor loans in Darwin. While, in the rest of the Australia will be 2/3. And Jeff, you can confirm this, 2/3 owner occupier, I mean. So with certain differentiating pockets. So yeah, exactly, and you can see, what is very interesting, and I saw that in Perth areas, you can see investor saturation. I think investor saturation can be really determined when you look at the vacancy rate. If the vacancy rate in the short term starts really increasing, you see that, it's sort of a tail ender of a hotspot. There's too many people. And you look at the growth rate, for example, and it's seen 28% growth in the last year, while the vacancy rate is rampant and increasing substantially. So those are one of the tell signs I would actually look at. But then as well, on the ground, you realize from sales agents.
And off the top of your head, Matija, sorry, Jeff, to jump in, just asking a question. How quickly, and for me, nothing beats, being able to see it, talking to agents, like you said, how quickly is like software like yours or even, realestate.com and PropTrack, how quickly is that actually analyzing vacancy rates from a movement perspective? Is that weeks, months? Is it quarters? What's the lag time on that?
Yeah. So that great question. Now, when it comes to aggregated representation of suburbs, data is recorded on a monthly basis. Now, I'm very big on trend analysis because you can see small variations within smaller timeframes, but sort of trend remains persisting because of the liquidity of assets. So now, when it comes to different tools like sold property search, listings, etc., that needs to be instantaneous as it is. You also have vacancy rate on a granular level, such as neighborhood, but that's updated monthly. Like I don't, from my experience, just because of the liquidity of property and how long it takes to transact, buy property and sell, and the fact that people like to hold on to property, and I trade every other asset class under the sun, like in shares, crypto, everything, and I trade them on a 15-minute chart,
Soybeans or not soybeans yet?
No, not yet. I'm looking into
well.
betting on running dogs. I just need to play the Ponzi scheme. What I was about to say, yeah. So in that instance, it's sufficient. I mean, the lag of a month is not a substantial lag, I would say. Now, for different other, inquiries you have, such as sold property and listings, etc., you need it to be instantaneous, so you can do, proper negotiation strategies, etc., etc. So, it's updated monthly on a monthly basis, because that's how the data comes in and just gets recorded. But we do it every 31st or 30th of every month at about midnight when everybody is sleeping. Essentially,
the 30th of February. Jeez, mate, you guys are not only you're creating extra time. Could you give me that extra 2 or 3 days, please? But no, sorry, I couldn't help.
I didn't know I need to name every month and when it ends.
Just 30 days of September. No. So look, I want to go. So let's go through a couple of examples of that people have thrown in, and there's been. So Werribee and Hoppers seem to also pop up, but I'm curious to see Aararat, and it is kind of to the left of Ballarat. There you go, rhymed. So it's to the west of Ballarat, and I'd say you probably got 10 to 15,000 if that's in that particular regional centre. Not yet. We'll add it up. Well, yeah, run us through your sort of very high level process, because this will give people the opportunity to see, and it'll help inform the next question as well.
See it now?
Yeah, yep. I've got it, mate.
Yeah. So Aararat. Now the way I analyze suburb pages is fairly quickly, because I know what I'm looking at now. I can see right away it's increased by 2% in the last year, so it's rebounded off. 3 betters are growing more than 2 betters and 4 betters, which is interesting. You can afford one for $392. If I move further down the list, I'll address the algorithm risk scores later, but let's look at industry diversification. What I do, let's say if people have long-term investment time horizons, I usually set the risk algorithm, which is essentially this score here. I would set it at greater than equal to 50, because that includes both industry diversification and exposure to negative environmental effects. Let's say I've given it a bit of a leeway, and I included this area into the list. We can see that industry diversification index is sitting at 59 out of 100, which means that it's not well, I wouldn't say it's undiversified, but it's not diversified. Essentially, it's sitting at the halfway mark. Now, there's no exposure to flooding and bushfires. What I find interesting, however, is there's very high levels of infrastructure spending in this area. Now, coming back to Jeremy's point before, there's 2 types of there's 10 types of infrastructure spending, but let's say 2 main types will be infrastructure spending within an area that is not diversified and usually caters to the single or 2 industries in question, not to the actual expansion of the suburb. And then industry infrastructure spending that's being integrated within a very diversified economy, which is a great precursor to population growth. So in this instance, I wouldn't say this is an undiversified economy, but there's a lot of infrastructure spending. So and this is per capita, per person. Yeah. So there's some liquidity injection there. If I had to give it, I'll give it a tick, but I will consider it as a short to mid-term tick, and I'll assess later. Yeah. If I look at the typical price curve, I always say to people, everything on the page is information. What do I see here? I see no sharp deviations to the downtrend. Now, is this area volatile? No, it's not. Has it grown substantially? Since 2007 to 2019, it was compounding. It was going up, but I see no sharp deviations to the downside. So I would give that a tick. I mean, it's grown 90% in 10 years, which means it's sort of like a great proxy of stability. I usually go to the growth rate. Sorry?
The thing I say about that is it's pretty much COVID. Like COVID saw, I'd say 60 to 70% of that growth in the space of 2 or 3 years. Like if you look back at, like you saw that big little uptick. Aside from that, what is it actually done?
Well, it was 129, 130 in 2007.
Yeah.
And then it was 236.
Yeah, so it's kind of
doubled. Yeah, so it's double without COVID. And then this was potentially the COVID pump. But most of these areas, you see in ACT areas, a lot of ACT areas have this hump, for example. Now, if you look at the growth rate cycle, now this signifies the levels of growth or rates of growth that have been experienced in the area. And we can see that this area has virtually I guess never gone below zero, only once by 0.35%. It was compounding for 199 months, meaning it was 199 months above the positive growth zone. So if I go calculator, sorry. So if I go 199 divided by 12, so that means it was compounding for nearly 17 years, which is reasonable. Now, just to give you a bit of perspective, everything needs to be apples for apples. You can't compare this area to an area that has 750K now, or a typical price. Now, what is interesting is that lower priced areas usually have a lower GRC index. What I mean by that, GRC index measures the number of months the area spends in the positive growth zone. So for lower priced areas, you would see a GRC index of between 80 to 120. This one is 199. So it's really interesting. I like what I'm seeing. Now, growth pattern deviation, what do we see? This area has grown 10% less in the last 3 years than 3 years before that. It has grown 18% more in the last 5 years than 5 years before that, aka COVID. And then you have 10% less, 1% less in the last 10 years than 10 years before that. So you experience a COVID pump, but other than that, it would be classified as a counter-cyclical investment, I would say. It has a lower URSAD. Now, as I said before, for price points that are below 600, URSAD essentially doesn't play a key role in growth. What plays a key role is the affordability levels. And we see that this area has a years to own, i.e. it takes 24.2 years on average to pay off a house on a medium income within that suburb. And then obviously supply and demand. Now, supply has been increasing in the last 5 years. It has been decreasing in the short term, and there's only 11 listings. So I always triangulate. These 11 listings are essentially 3 month, the percentage is 3 month rolling average, and there's only 11 listings now, which is not substantial, and we see improvement in supply short term. Now, I would need to see this short-term trend reduce and continue for the next year, so I can say that it's an established trend of scarcity, continued scarcity. At the moment, I can't really vouch for that. On the demand side, what do we see? We see a scatter plot. There's been a lot of discounting happening. And now, by the way, this doesn't mean that this area is bad, but it just means that you might have to wait longer to actually generate the 20% or meaningful returns, i.e. 4 years or 5 years, which means that you're getting into the area earlier. Now, what I don't like about this area is that the days on market has been increasing for the last 5 years, and it's been also increasing in the last year. So what I usually call a warm spot is an area that has a reducing supply both short-term and long-term, and then a sharp deviation between the long-term trend in days on market and short-term trend, meaning even if the long-term trend in days on market is increasing and short-term trend there's a deviation and there's like a decrease in days on market, I can see there's a shift in the market. Currently it's sitting on 64 days, 3 month rolling average, and the vacancy rate is higher. So sitting at 2.2%. Now, I mean, you can buy a rent property that's already been rented out. Building approvals are increasing, but sitting at 24, which is 0.57%, which is neutral. I would say expect a little bit of an influx in 2 years. And people like to live there. I mean, a whole period of 9.74, 10 years, nearly close to 10 years, signifies that owner-occupiers like to stay there. So I guess overall, I'll give it a 6 out of 10. It will be potentially a great area to invest for long-term, especially if you have a restricted budget, but don't expect to see Perth, Townsville returns or anything above 30% in the next, I would say, 4 years. But if you want to hold it long-term, it does provide for some, a reasonable entry point, primarily because it's very affordable for the owner-occupier base, and the volatility is largely reduced historically there.
There you go. Jeremy, you probably know Aararat, I imagine. You've seen a lot of areas.
Seen this area over many years. I've actually looked at it myself personally, probably about maybe 5-6 years ago before COVID. So I'm actually quite upset to see how much it did move during COVID.
Yeah.
So that's because I ended up buying in Victoria personally myself back in 2022, only because things were just so cheap. And how I assess things is, well, that property was selling for that price 5-6 years ago. It's going to get there again. It's just not the flavour of the week. Question I asked Matija is, what's the importance now? And again, speaking from experience, decades now in the industry, I started as an accountant. There was probably 5 or 6 prevalent property professionals in the country. Now there's thousands. What's the prevalence of property professionals, again, from a data perspective, but also then now driving lots of people to maybe price point areas which are more conducive with what you're seeing in your platform, being the lower price point? Do you think that has some form of sway and swing in some areas booms or some areas busts? It would, and again, also a professional opinion, not a advice or anything, but a professional opinion.
No, I mean, we do see, especially with higher volume buyers, that, there's an issue with listings that we discussed previously. So they do tend to drive traffic towards a certain area. Now, I always say, let's say with our members, I always say when we're constructing a filtering algorithm to shortlist, I always say address the supply side first, not demand, because supply is something that you can't really control. Essentially government controls the supply, and you and I, we don't know when we're going to sell our assets, but demand can be controlled. I have a community of 8,000 members, and I can just say, let's go to a single area. And if 30% listen, I'll really manufacture a lot of growth there. But like, even if I manipulate the demand side of the equation, I'll still see minimal growth if there's an oversupply. So now on the one hand side, as I said, yes, there is a tendency for people, because the listing scarcity, to drive traffic towards a certain area, and also because they're not investing for the individual brief. If I would say if everyone is going to a single area, putting, let's say, 50 clients in a single area, I don't think they're actually assessing those clients' briefs, investment time horizons, equity extraction timeframes, and everything else we discussed. So now, and what happens in that instance, usually when people pile into a single area, because all of those 50, 100, 1,000 people that bought there, they all have different needs and desires. Let's say I could have bought there just to sell in 3 years to pay down my PPOR. My neighbor could have bought there in an SMSF that will sell after 5 years. And another guy's investing, essentially 10-year plus. And in that cohort, you're going to have a percentage that's going to start selling off at a particular time. And when they start selling off, you will then see essentially a bit of more turbulence and volatility within the area. I guess a caveat would be, even if you follow the group, as you said, that might not be a wrong strategy, because you're going to get momentum growth, but ensure at least as a safeguard so you can sleep at night that there is a continued supply scarcity, at least for the last 5 years, which will give you a bit of room to breathe there. At least it's not going to go in the negative growth zone when everyone starts selling off. So in a roundabout way, to answer your question, it does happen. I think, two things are the causality of it. First one is the inability to find listings everywhere, so people are forced into a single area. The second thing, I wouldn't say malpractice, because it's a harsh term, but the second thing would be essentially you're not buying for the client, him or herself, and for their brief. And now if you find yourself on the sidelines and you want to follow the group, I guess my caveat would be really look at the supply side. Because if you've bought in an area that has a manufactured demand side, and then there's trickling in supply, and at least a balance or overabundance of supply, you're going to see a lot of pain.
So I think that's one of the main points. Again, everyone listening, what Matija said, actually focus on supply first before you consider demand. And that's probably something I need to take up on my own investment strategy, because I actually focus on demand first. Then I may look at supply later on, but I'm always looking for what are the demands and how many people are getting in and how much that particular area is spoken about. And then that will kind of influence my decision and potentially business strategy around the property. But I think for everyone listening, focusing on the supply first might be the safeguard. The big one I want to ask, and again, you're brilliant with the statistics, why Tasmania now is starting to go through a run. It's obviously in the tip of everybody's tongue from a property professional perspective. I've seen 30 transactions occur in the last fortnight. Again, I probably saw 6 happen in the whole year of 2025, and I've seen 30 in the short time that we've had in the month of February. So what's driving it? What can you see from your data? And is that a spot where we as investors should be looking in 2026 to make some good coin?
Yeah, so it's an interesting
Jeff,
one.
I stole your thunder on that one. I know you probably wanted to ask that question, but I'm
I was
just
going to ask about.
No, it's essentially, it's essentially the question with always the same answer, in a sense that Now, there is obviously in every type of investing, there is a bit of speculation. I mean, I know I've received phone calls from our members where, they don't know where to go because the yield issues in Victoria. They know that, WA is at the peak of the cycle. They know that Townsville and Cairns have seen a lot of growth. New South Wales is stagnant. So where do I go, essentially? What is my next? And they're sort of forced to look elsewhere. And I think individuals that I spoke to, and every time I speak about, let's say, Tassie, I will say, well, when you speak to your client, ensure that you set the right expectations and you say, well, you're not going to get 20% growth in the next year. You're entering a market early. Now, again, it comes back to drivers of growth. You need supply scarcity, you need very high levels of affordability, you need a demand improving, at least in the short term. Same things we've gone through Aararat. You need an area to be at the bottom of the cycle if you want to take advantage of that counter-cyclical investing, which means your brief is an equity extraction timeframe of 4 years as opposed to 2. You're sort of entering something earlier, and you're going to sit out, or essentially sit on the sidelines for the growth to happen. So what's the reason? I mean, I don't know many Tasmania areas. We looked at one area which was very interesting, Lena Valley, for example. It's at a bit of a higher price point. There are 2 reasons, why we're interested in this area. First, there was a very decent listing there that we could acquire. But the second thing is, again, supply was very scarce. Socioeconomics was elevated, 7 or 8, I think, from memory. Price point was about 750 to 800, while the affordability index or years to own was it takes 30 years on average to pay off a household. And in the context of all of the other price points, that's very affordable considering, So that's why we really like the area, and especially that area had this divergence that I spoke about. So it had a divergence between long-term and short-term demand. So long-term demand was weakening, or days of market was tracking up, while the short-term demand took a substantial U-turn. So you saw in the last year, you saw a substantial nosedive in the days of market. And I think at the time when we were looking at the area, I think it was sitting at an average of 15 days, which is insane.
Wow, okay.
Or 3-month rolling average, which is insane. So that tells me, okay, the area is picking up. It's, essentially the interest is picking up while there's like 3 listings in the area, and property is extremely affordable. It's like, this is what I call the perfect storm. So I think I can vouch, or I can say that I looked at the Lena Valley suburb page. Now, there are other suburbs, Glenorchy, Launceston, I don't know, is that how you pronounce it or whatever. I haven't dug deep into those suburbs to actually have a look at them. I think they're of a lower socioeconomic standing, but I do know that a few buyers agents are buying there. And I think the result is, well, we don't know where else to go, to be honest,
There you go.
We don't know where else to go. While this, and again, it's a box ticking exercise. I always say to every investor, don't chase unicorns. They don't exist. They don't exist anyway. You can't make a sandwich that's perfect, let alone buy a perfect property, So it's like, if you have out of the 10 boxes that you want to tick, and you can tick 6 and you don't know where else to go. So you're like, okay, I'll consider it. And especially if it's at affordable price points. I think there's a psychological element to it.
There you go. Okay, look, we've got to run our second sponsor, and that was an interesting. I feel very conflicted about Tassie because I just sort of see that I think that yes, it almost feels like a bit like the demand thing is what's ticking into it. So I don't know the supply. I mean, I'm not talking about your particular example, Matija. I'm talking about there is a lot of demand and a lot of that going in, and I just question, well, are people know what they're getting into? Like they're almost making comparisons. They're trying to make comparisons with Elizabeth and that. And I'm like, well, Elizabeth was 200,000, 250. And you're talking about some of these outskirts of Hobart. And I know it's 2026, or 2020.
And just as an added on thing there is, and this is a standard thing that people say, but it's actually true. There are markets within markets, and we paint the markets with the same brush. We say Darwin, and I would say stay away from 99.9% of areas in Darwin. And even the ones that you go into, you have a short investment time horizon. The same goes with Tasmania. Like you'll find real dog shit. Sorry to say that. And you'll find some areas that are reasonable and that are very interesting. Now, I have a different mindset. Like I use a similar methodology for a long time, and I've seen the returns that our clients are making. So I'm sure in what I'm looking at, and I'm prepared to make the next step. So if I see 7.5 out of 10 boxes ticked, and there's nothing else out there for me in my comparison, I make a call. I think the worst call you can make is, and this is not financial advice, and comes back down to personality, but I hate sitting on the sidelines.
Yeah, I think that's like between. So I've got an idea, and you guys have been pretty public what you've done as well, Matthew, your portfolio, yours and Alex or Sasha, and Jeremy. The thing that I've noticed about you over the years is that you just make it happen. It's not like, oh no, I'm going to wait for 8 years or 8 months to do it. It's like when I'm ready, you strike while the iron's hot. You're there, you're making it happen. So I think that's probably the takeaway I'm hearing, Matija. Stop looking and chasing unicorns.
Man, if I had, honestly, and I'm in a peculiar position because, as I said, again, like we invest a lot of time into dealing with our customers. And I know when they were looking at something, what the shortlist was. I know because I ran the strategy session. I know because I spoke to them. And then they come back to me 6 months later and they're saying, Matt, I can't find anything in there anymore because it's increased by 60 or 70K. And I'm like, or 50K, whatever it is, that's substantial return, but it does happen. You know what I mean? And like, what do I do now? Now you're forced to go to a plan B or C, which is, higher opportunity cost in that area because you didn't want to make the call because you were looking for rooms that are 2.5 or 2.5. I mean, who cares? Like I see that time and time again, like it's just crazy to me. But again, different personalities, different risk profiles.
That's right. We'll throw an next sponsor, and then I'll throw a little, not a curly, but it's probably a longer one that'll wrap us up and into Q&A. So it's been an amazing session so far. Thanks, Matty and Jeremy.
Oh, Jeff, I wish there was 3 investing books that covered everything property.
Oh, Joe, there is. Steve has 3 books now.
That I do, guys. I've got 3 books now. You probably don't even have to follow this group anymore. Just kidding. You want to keep seeing and hearing from me, of course, so stay involved. But in all seriousness, if you want to get the full picture of investing, residential, commercial, and development, these 3 books have you covered for the fundamentals. For OzProp members, here's the best part. I'm giving these books to you for free. Just cover the postage and I'll send them right to your door. Go to policeyproperty.com or click the link below and get your copies today. You can also get all my spreadsheets, checklists, and resources free on my website. Happy reading, gang.
Good old lucky Steve. He's Steve has been talking about having a kid for the last probably feels like 2 years now. So it has come to good old Steve. He'll be back soon, I'm sure.
Congratulations to him. He said his second child a couple of days ago.
Big congrats. But so this is an interesting one, Matty. I know this is probably like a whole session in of itself. So it says my budget is, you can, I suppose, insert some parameters if you need to. On this, and just tell me if it's too hard to do on a live session. Please tell a couple of hotspots. Let's just say not a hotspot. We'll I suppose filtering in regionals close to the coast. So,
See, there's cognitive dissonance in that question. Okay, and let me elicit what the dissonance is. You can't be looking for an area that's going to give you X amount of returns in X amount of years with a restricted time frame, and then delineate the area where you want to go. It's like, you're looking where that will happen, while at the same time, you're tripping yourself up by saying, well, I want to go regional coast. Maybe the regional coast doesn't have that. So you either want to satisfy your brief or your returns, or you want to go into an area. If you want to go into an area, you don't need filtering. You don't need anything. You can just look at the map and go, boom, I'll buy here, and that's it. So again, I'm really cautious when people have an idea of where they want to buy. If they have an idea of where they want to buy, the question is superfluous. It's as simple as that. So now coming back to the actual brief. So what is it? It's 600
650, and it looks like a short-term equity extraction. Let's assume that, and we'll just not get rid of, but we'll sort of skate over the close to coast because I
didn't want to be an idiot, but I think people need like a bit of a shock to understand that they're thinking about it in the wrong way. Okay. So if you want to find the area where it's going to give you the returns, put your views aside. Now, we might settle on a coast area, which, I don't know what's going to be produced, But if you already have an idea in mind, you're really tripping yourself up. That's all I'm trying to say.
So Matija, in a situation like this, for this person that asked the question, 600 to 650, 4 or 5 years, right?
Mm-hmm.
Would we be looking at, because we don't care about long-term sustained growth, we don't care about all those metrics in the longer term, are we then focusing on specifically then demand? We're looking at that herd of people getting in, because again, for an area to grow, it still needs people to come in and pay more than what the last person did. So that's demand going to drive that growth. It may not keep it sustained for 10 years, but would you say that's where we do focus? That's purely look at demand, purely look at the big bubbles on the HTAG platform and really disregard supply because of that 4 or 5 year horizon?
No, because growth equals reducing supply, increasing demand. You need both. You need both in order to see growth. Now, the individual wants to experience substantial amount of growth, and they want essentially to enter a hotspot or maybe a little bit prior because they're going to hold it 4 to 5 years. I wouldn't recommend releasing any equity. I would just recommend riding the wave just because of uncertainty, what's going to happen in the future. But they want an area that's on the upswing that's going to continue growing for the next 4 or 5 years. So in order for something to continue growing, you need 10 people buying one house. So supply scarcity, increasing levels of demand. You need both. And you need elevated affordability to increase those 10 to 15, essentially, potentially down the track, and have FOMO and all these other things that have happened in Townsville and Perth.
But is the affordability, and this is the question I ask, if we've got a substantial amount of East Coast investors where, let's face it, we've got the highest level of equity compared to any other state in the country, we've probably got the highest level of aggregated income compared to most states. I won't say all states because there's more millionaires in WA per capita than any other place in the country. But if we're driving affordability, let's say East Coast is predominantly where a lot of investors are, going and buying in, let's arguably say Dubbo for argument's sake, where average income there might be 70 grand. Are we then tripping that up because we're bringing in city-based income and buying in regional country-based areas? Investors in a market that may not have anything more than 4 to 5 years in it.
So it comes down to what you said before. When you're analyzing areas, you want to see the percentage of investors and owner-occupiers. You know, in most markets, owner-occupiers dominate the purchasing, especially at the onset of the cycle. You know, investors start piling in when they start seeing some growth. And as well as when it comes to longevity and lack of volatility, it is the owner-occupiers that maintain it stable, essentially, you know, because investors buy and sell. So you definitely want to see both cohorts participating and fighting for the same asset. You just don't want one dominant cohort. Now, when you have, you know, East Coast coming in with a lot of money, you also want at the same time for the West Coast to be purchasing the owner-occupier population for them to be property affordable. So they start competing between each other. Which is why, you know, some owner-occupiers get priced out of the markets. You know, we saw that in Perth as well. So you need both cohorts to participate in order to increase, again, coming back to probability, in order to increase the probability that you'll see a burst for the next 4 or 5 years. So again, coming back to the proportion of investors and owner-occupiers, and I mean, putting aside Darwin, I do think that allowing for contingency in every other market, it's 50-50 game. You know,
50-50 is in like,
as in 50 owner-occupiers, 50 investors, you know, and I'm exaggerating for effect. I think there's more owner-occupiers in other markets, but, you know, let's say it's 50-50, while in Darwin is there's a high investor population. So it's a positive that East Coast has more money, but that is not sustainable. It's just the East Coast is buying. So I need to assess how much people, because there's plethora of research done, but people buy 10 kilometers, 5 to 10 kilometers within where they rent anyway. So, you know, if you're going to switch from renting towards ownership, you're going to purchase, essentially you need to have that area needs to be affordable, or the property needs to be affordable for the residents that are within that area at the onset, and then everything else trickles down after that, you know.
So Jeff, at 600 to 650, where does this young man go to for a spurt?
Yeah, so,
where do your numbers look at? Where do your stats say?
Jeff, that's a tough question.
So, I mean, as Jeff has mentioned, we can talk about this for like days, but I just did quickly a comparison, and just guys, quickly, this is the research algorithm that needs to be there for that strategy. What is the strategy? 550 to 850 mid-risk. And remember, risk is associated with time frame. So if you have a midterm time frame, you can sort of adapt more risk as long as you time the entry into a particular area. And it's a warm spot transition into a hotspot. I can't really explain the algorithm. It's going to take a long time. And then I did compare all of the suburbs in the short list across additional 50 metrics by assigning weightings to metrics to just nuance, I guess, the growth component in the 1 to 5 year mark. And this is the short list, the ranked short list, essentially with scoring. Djolic, Northern Territory comes in first, and I agree with that. Everything down underneath, I wouldn't hold it 4. I'll hold it 6 or even 7.
Yeah.
Okay, so Djolic is going to give you that return in the next 4 years, and at which point I'll really reconsidering exit. But all of the other Victoria areas, although they're rebounding off the zero line, and you got Dubbo, by the way, Jeremy, interestingly enough, and you got you got Tassie here as well. All of these areas, I don't think will give you that substantial growth spur because they're not. I mean, if we look at the growth rate in the last year, and it's a great proxy, by the way, there's a thing in statistics called recency bias, which states that the best predictor of short-term 1 year future growth is what has happened in 1 year in the past, has by far the highest correlation, which is why growth rate in the last year should be really taken seriously, especially when we compress the investment time horizons, i.e. to 4 years. And you can see that Djolic is essentially pumping. And because we already established supply scarcity, not only current supply, but as well as the trends. We looked at the stock on market slopes and inventory building approval ratios and hold periods. Because the supply scarcity is continuing, while there's substantial momentum, this momentum will perpetuate into the future, and it will be a decent play for the 4 years. Everything underneath, you can see that the growth rate's a little bit diminished, and just under promise, over deliver. I wouldn't hold it for 4. I will hold it for 7.
You mean the ones under Djolic, or? Yeah,
so Alfreton, Ballarat, North, Brookfield, Dubbo, etc. I mean, what we have 18 entries. Some of the entries are double ups because I enable the bedroom filter. We have a separate data set for each bedrooms. Each bedroom, for Djolic, 3 bedroom is your play, not 4. So all of the other ones underneath, I mean, I can go into the suburb pages to really delineate and say, is it a 7-year play or a 6-year play? It will just take longer. But Djolic is the only option, which is not the coastal one that you're looking at. And it's a perfect example.
In Palmerston, good old Palmerston City.
Just so people understand how I got to this by analyzing 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, and another 45 metrics, to get to that. So I in my view, I dot the I's across the T's.
It's interesting because all those areas, Matija, I've seen someone purchase in the last probably 3 weeks. Every single one of them.
Yeah.
From South Launceston.
I mean, it does. It's definitely warranted, of course, because look at the growth rates in the last year. So all of these areas are really approaching the elevated, close to 10% growth, which is 10, 15 offers for the same house.
Unreal. It just because I see this stuff, Jeff, it's crazy because every single one of those areas on that screen. Now, I'm not saying for everyone that's listening, that's it. This is gold. You go buy there and go throw money. But yeah, I've seen every single one of those areas being purchased in the last fortnight by clients.
Yeah, and this is what trend. Yeah, this is what I mean. For example, now when we rank the suburbs, we'll go then inspect the suburb pages, the heat maps, etc., and then we'll print out a report, and then goes back to what to the bubbles. It gets recorded. So that's essentially it, Jeff. I can provide you with this list at the end if you want to share it with your community as well. I'll actually print it out now. I will give you the entire data set, i.e. all of the metrics. Do you think your listeners will like that, or
is that the best? Is it the data dictionary that we're talking about here, Matty?
Sorry,
is it the data dictionary? Those definitions that we're talking to here. Like, is it on your website or?
Oh yeah, it's on our website under support. I can even send you the data dictionary. It's fine. Yeah, But I'll
Yeah,
send you the stats of those areas if you want to share it with the community.
I was going to drop it in the link, but that's all right. All good. Yeah, flick it to me and I'll do it. Yeah, because I think the interesting thing to Jerry's point, I think there's that sort of demand and the groundswell. Like, yes, we all sort of hear it, and yeah, Victoria, you sort of start to see so many people. Haven't seen personally so much in Tassie yet, but it's definitely over the last probably 9 months, even 12 months. Like you definitely like. I have a bit of a bird's eye view and see a lot of posts and a lot of comments. So Tassie has, the ones that I'm not seeing as much, anywhere near as much interest, but they're still increasing quite rapidly is Adelaide. But here it is here. Okay, I was just going to post it in the chat, but I'll do a post on it because I think and then people can actually watch back this session and get the context.
Yeah, just please, for my sake and everyone else's sake, just let's also define the brief, because people are going to assume that this is great for long-term investing. It's the brief was 4-year extraction. Djolic is the play. Everything else is much longer. You need to make much longer to generate the 50-60% returns. So Djolic is the only play for this individual, in my view. Personally, what I would say, if I was sitting on a strategy session, I would recommend Djolic.
Yeah. And I think we'll see that just out of pure necessity by people and investors, $600,000, $650,000, $700,000, those price points and the areas in those price points, they'll just continue to do well if it's going to be heavily investor driven, and owner occupiers will start to have a little bit of fear as well. But yeah, I think people need to also look at that. I personally, from my own property portfolio, try to go outside, where typical mum and dad's budgets are, and I find that I tend to deal with people that are looking at the property at the same lens. People that are owner occupiers that are willing to pay whatever for it, I can't compete because I still have to have an investor lens through it. But again, seeing what I am seeing from the cohort of clients that I've got, it's going to continue to pump in that price bracket, and you'll see it flirt up to the top, where things become a little bit unaffordable. It may come back down and continue to bounce off the top. But the flight to areas of an affordable price point, I think that's going to be still the flavour of the next couple of years, because there's still a lot more people wanting to invest, and there's an insatiable excitement to it as well.
Yeah, it's the affordability issue, affordability crisis. Like we just can't afford, but we want to. I see a lot of people recently. Sorry, Jeff. I see a lot of people recently as well, flipping the lens a little bit, and I don't know, Jeremy, if you're seeing this, investing in property to alleviate the PPOR burden as well. And to pay down their PPOR, which I condone. I really like that strategy as well. Some don't want to be prolific investors. Some just want to, essentially pay down their PPOR. And, it gets really interesting when you use certain strategies and you can leverage this burst and market momentum. You can pay down your PPOR, sooner, essentially. So, it's a massive thing doing that, because if you've got a mortgage repayment of $60,000 per year and you can buy and sell a couple of properties in 5 years, that's like taking your spouse out of the workforce, right? It's huge. You become a dangerous person, because that means every dollar then you then earn can go towards investment. I've done that personally. I have sold properties to capitalize on profit, pay down debt. For me, it's always looking at contingent liabilities. Now, if you're out there listening, you might be holding a property that's doubled in the last 3 years, but it might be a 1960s home, original wiring, original kitchen, original plumbing. You're getting thousands of phone calls from a property manager. How many clients of mine in Townsville are now considering selling? Not because they haven't done well in Townsville. They're sick and tired of getting phone calls from the property managers every week about something else to fix.
Mold as well would be probably a big one.
Yeah. Mold. That's far north Queensland, guys. The higher rents are there because the higher cost of maintaining the properties has always been there. You get 100% humidity, and you get 40-degree weather, and you get monsoon rain. So that also starting to play into a lot of people's decisions and thought process. I've doubled my money and I'm getting thousands of phone calls. Is this a time to sell? Well, as long as there's a plan of what you're going to do with that money. Buying Ferraris doesn't necessarily cut the cake sometimes.
Depreciating asset. That's how I look at it.
That's it.
The thing I sort of, having seen a few trends along the last 5 or 6 years, I think it's unfortunately reality, but I just think that people are looking for that almost share market, the crypto hit from property, which it's sort of people have been conditioned, which I don't know. I don't know if it's really. I mean, it's not wrong. Right or wrong is a relative subjective. But yeah, I'd just say maybe think beyond the scope of that. Not to say don't buy that property, but just think, okay, there's property beyond that. Maybe I'm too old school. I'm getting mid to late 30s now.
No, man, I do the same. I think you're right. I think, I guess it's people just don't know how to handle the cost of living and everything like that. So they start speculating much more. And you said, crypto, et cetera, that's the lifeline. And also the Perth boom. Do you know how many people I get and they ask me, can you find me the next Perth? Well, the next Perth was Townsville, but sometimes the market doesn't allow you for the next Perth. And Melbourne is not going to be the next Perth. While it could be the highest generating growth, annual growth in the next couple of years, but it's still not going to be 20 average annually like Perth was.
It was just insane. The velocity of people buying there was, I have never seen that in my investment journey and probably never will see it again. That was a once in a lifetime thing.
What I find
bad in Sydney in 2012, 2013 though, Jess?
No, that was insane. I have never in my lifetime as an accountant, I've been dealing with thousands of investors every year. I have never seen the volume of property and the concentration of buyers agents. And again, I manage a huge number of buyers agents in the country and investors, and I've never seen everyone converge on one state like a pack of wolves like they did. And you know what? People make truckloads of money. If you've sold out and done well, congratulations. If you're still holding, have your plans in place. And if you've done well, congratulations.
Yeah. All right. On that point, look, this has been an amazing session. I've loved the far-reaching, and it's just been great to have your insights and flavor upon the session as well, Jeremy. Thanks for coming along, and appreciate. I'm going to give you guys both the opportunity. Jeremy, first of all, if people want to get more of you in their life, how do they find out more about Jeremy? And then we'll go to our guest of the hour.
Yeah, you reach out to us on our website, pradiumpartners.com.au. And as Jeff mentioned, I've got a podcast called What School Should Have Taught You, where I'm very transparent with myself and other professionals coming on board. And it's all things about finance and financial literacy. So having a lot of fun doing it.
Yeah, that's right. Thanks, and thanks for your contribution there, Jeremy, to us and over the years. And Matija, where's the best spot for people to check you out? Because you are the CEO these days. I suppose the reluctant CEO, but the very
I'm the CEO next door. The girl next door. I'm the CEO next door. Yeah. Hey, mastermind.htag.com.au. I manage the community there. I spend most of my time there. That's essentially it. You can find me on LinkedIn or Facebook, wherever, but mainly I'm in Mastermind. Yeah.
The comments. I'm just trying to see. I'm trying to give you guys it's hard when I'm trying to speak in also, but I'll do my best. I'll sort of, people are saying, Rebecca said, love hearing Jeremy talk about his bird's eye view of what people are doing mixed with Matija's data. Yeah, I think I sort of was able to bring, some great professionals at the top of their game tonight. So you as the co-host, Jeremy, and Matija as the host. So check out Matija on HTAG with a mastermind. He's amazing. And also, guys, this has give us that 5-star on Spotify as well, because this helps us put together. I should have had this prepared, but anyway, guys, it's been a great session. As Joe likes to say, let's go and buy a property. Let's go and, I suppose, buy a hotspot, where to buy in 2026. See you, everybody. Thanks for your time.